Okay, Ryan here with James looking at a mortgage coach analysis. And what we're trying to do, James, is look at a current mortgage with about 25 years left. And we're going to see what happens if we try to reduce the rate even a little bit, see if we can't save some money and get the term reduced.
Yeah, exactly. Let's actually say you took out a 30-year, you bought your home about, let's say, beginning of 2015. You purchased your home for $375,000. You put 20% down, so you started with an original mortgage balance of $300,000. Your value, let's say, you did a little work to the house, market is appreciated, you were lucky enough, you got a short sale type situation and the market's really turned, and let's say your house has appreciated considerably in that amount of time. For this scenario, it really doesn't matter what your home is worth today, as long as it's worth what it was that the time that you bought it. And I think we can all agree that it's definitely worth what you bought it for. If you bought it at the beginning of 2015, probably even a little bit more. So let's even say, be even more conservative and say your home value today is somewhere around 400,000. So what we're looking at, what a lot of people don't think is, hey, I had a really good interest rate on my, mortgage, and I probably don't have to touch it ever again. And if I wanted to, take a look at maybe just paying a little bit more towards the principal, I'll just be in pretty good shape, and that's what I can do. But unfortunately, what happens a lot of the time is that we don't do that, and we continue on with our 30-year and paying the higher interest and paying a lot more over the life of the loan than we really, could have done something to reduce that cost. And I always say, use your money to work for you instead of just writing in the monthly mortgage payment. So for this example, let's say your current interest rate is at 4.25%, which is still a very good rate. But a couple of years ago, maybe your mortgage was a lot to handle, and the payment was a comfortable spot. And obviously now you've done a little bit better income-wise, you're a little bit better financial position, and you're starting to think about other things like long-term retirement planning, your kids' college education. Where can you free up some savings in order to fund those things? And we always think about savings as being a lower payment, which it is, but we don't ever think about the interest that we pay, or we don't think about it as much. So there's definitely a couple things that you can do right off the bat and look at to say, hey, let me compare these things and see if what that might look like for me today. So a couple of examples that I'm looking at here is, let's say you have a 25-year scenario. So you have 27 and a half years left on your mortgage. You bought in 2017. You could drop it down to, let's say, a 25-year or even a 20-year fixed at a lower interest rate. What does that look like as far as a payment? So on a 25-year situation, your payment is going to be a little bit higher than it currently is, but instead of having 27 and a half years left, you only have 25 years left. And it's a little bit more in a 20-year situation, but now you only have 240 payments left as compared to having 27 and a half years payments left. And so what does that look like as far as overall savings to you? And this is, of course, how banks make their money, is the amortization of the interest over the life of the loan. And so this is what you really want to look at, and where your situation might be over this. What we're looking at is over those 25 years, what does the current situation look like? What would it look like in a 25-year scenario? And what would it look like in a 20-year scenario? You look at these home values and you say, my house is never going to be worth that much. But all we're doing here is applying 3% annual growth, increase in value, compounded over that time. And for those of us that have been around for 20 years know, in fact, that, hey, somehow we get there for the most part. And you look at historical numbers, in fact, from 1960 to 2004, before the craze and the crash, real estate nationally was returning 6 to 8%. So these numbers would actually be much higher. So over the next 25 years, if you remained in the same mortgage, you would still have a balance left. You would have a good amount of equity. This would be the total principal, the total monthly payment as far as principal and interest, the tax benefit, and this is basically what the total interest, and if you had mortgage insurance in this case, you didn't have, would look like over out-of-pocket expense. Same thing here. You'd build up more equity. You'd actually have the loan paid off. You'd have all of the equity of your home. So you're talking about an additional $145,000 in equity over a 25-year period that you would have freed up, which means you didn't give that equity to the bank. You put that money in your pocket, and you're saving that much money over the 25-year period because you reduced the term. And that's only by increasing your payment about $80 a month and paying that mortgage off in 25 years.
So let's say that again. The $80 a month translates into $300,000, or the difference in equity, which is like 142.
Correct. Yes. Because you have reduced the interest and you have reduced the time of which you're going to pay off that interest, you're freeing up that much more equity over that 25 years.
Right. So the return on that, if you did the math, $80 at 25 years, I mean, that's pretty good.
That's right.
You're keeping it instead of the bank, basically.
Exactly.
Yeah.
And again, you might be in a better financial position and you're a little bit older and you don't want to pay your mortgage for the next 27 years. So you're looking at things that you can do and invest in your real estate. And so even if your payment is going up $288 a month, which would be the case in a 20-year scenario, you will pay less interest over that 20-year period, okay, about 79,000 or so. Sorry, about 76,000 or so just in interest savings, and you're done after 20 years, which means you will have, in this model, since we're looking at it over in 25 years, it's going to be the same here, but in reality, in 20 years, you're done with the total payment. So you're actually, compared to even the 25-year, you have 5 years or 60 months less of payments.
Okay, so I'm getting the big picture here. Basically, if you're sitting right now thinking about what you can do to invest in your future, looking at your mortgage might be the first place to go.
Yes, because if you look at it, why would you want to give your money to the bank if you can invest in yourself and accelerate the pay down of your mortgage, which creates more equity, and you save on the interest expense? Why not do that if you can afford it?
Right, because that $80 or $200 a month, where else are you going to put it and get that kind of return anyway?
Exactly. You know, you can definitely say, I'll put $200 a month into my IRA. You're subject, obviously, to market returns, which, you know, are there long term. But here, you're just, if you look at the total payment saving, the less that you'll make, there's about 20 grand there. And in the interest expense, like I said, that's about another 76,000 there. That's already 100,000 in mortgage expense that you're putting in your pocket and paying your mortgage off in 20 years. So would you invest 50,000, right? Because if we're talking about roughly $250 or $288 over that 20 years, or 60,000, to then put over 100,000 back in your pocket, plus your loan balance is gone. So again, it's about the difference in the equity is you have 150,000 in equity more available to you year 20. You have 70,000, 75,000 plus in interest savings, and you're making less payments total dollar-wise over that time. So you're talking about a couple $100,000 plus in reduced mortgage expense over the next 20 years. So really, you're looking at interest savings and payment savings of over $10,000 a year.
Yeah. Yeah. Wow. Where, in my head, I'm going, why isn't my financial advisor? I've never heard a financial advisor, like the guy who sells me life insurance. He's never brought this up.
So because his job is to get you to reduce your payment, stay in that 30 year and say, well, look, you're going to save on the 30 year. Yeah, it's great. You can go to a 20 year and pay it off faster, but you're going to save $288. Give me that $288 a month and I'll put it into an investment for you.
That's more of a gamble. You don't have as much control over that as you do in the value of your own house.
Right. Exactly. It is an asset. And, again, I'm using 3%, which is half of the national historic average of gains. You always have your equity available to you. You can pull a line of credit to fund other things that you would need to fund and still accomplish the things that you want to accomplish. And yeah, you don't know what the returns of those investments are going to be. Again, historically, the market does appreciate, and I'm not saying that you shouldn't fund your retirement and things like that, but this allows you to keep more money in your pocket over time instead of giving it to the bank. The bank wants you to keep a 30-year mortgage. They want you to. They want you to make more payments over time. So the fact that you can accelerate that, and I think this is very realistic because, again, yes, I'm going to increase your expense by your payment by $288, which is about $3,450 a year. But if I told you to make an investment for $3,450 a year to save $10,000 a year in the long term, do rough math, I think that's about 300% return on your money.
Yeah, and you're free from your mortgage payment that much quicker. Just logistically, it gets you faster to a point where you don't need to have that cash flow going out. You don't have to work as hard.
And at any time in between, if you need to tap back into that equity because your daughter decided to have an extravagant wedding and you needed a little line of credit, so you'll have that equity there to tap into. So it isn't like you're making a payment and it's not going anywhere. It's obviously reducing the loan balance. Your property is appreciating at the same time, so you're building your equity position that you could easily tap back into. And yes, $3,400 a year is a lot of money, but if we look at increasing wages on average, 3% a year, let's say, again, if you're in the same line of work or you're in a better place than you were 2.5 years ago, I would say your wages have increased compounded 3% a year. You're not going to feel that $280 a month. You're going to feel it though in 20 years when your mortgage is paid off. Instead of having, and I did this in 25 years. If we go back here and I just do this in my assumptions, I can take a look at, let's say, make this the 20-year.
You're also assuming somebody's pretty low, 4.25. If somebody's watching this right now and they're up in the high 4s or low 5s,
that's right.
The numbers could be all that more powerful.
Well, if they're in that 5% plus range, then you're absolutely you're talking about huge savings. So then it really becomes a no-brainer.
And the reason we're bringing this up now is we're thinking about this a lot is because the interest rates are so historically low. I mean, 3.25 or 3.5 is amazing.
It's free money, really. I mean, again, if you look at the cost of inflation, and I'm just going to take this back here, it really is. There's really not too much, cheaper you can get than even in the environment that we're in, where interest rates are up a little bit compared to where they were, but it's still very, very, very cheap money. And so you should take advantage of the lower rate, and you should take advantage of paying it off sooner. And I just want to show you this comparison real quick. So we did the long-term analysis over 25 years. If we go to 20, which is our shorter term in this scenario, we can take a look at this again. So now if we look at it in this scenario over the 20 years compared to these, okay, which it might be actually a lot better way than we were looking at it. After 20 years, I am paid off for my payment being $288 more a month today. My balance on my current mortgage at 4.25 with 27 and a half years left, I'd still owe 110,000. Even in the 25-year scenario, I'd still owe 85,000. So yes, I made more monthly payments, but look at the difference in equity.
Yeah.
I saved $200,000 over that 20 years. Again, 10 grand a year. I'm just showing it clearer to you here, I think. That's 10 grand a year. Again, if I told you, if I was your insurance guy and I said, Ryan, give me $3,500 a year and I'll give you back 10.
Yeah, you couldn't guarantee that because it's subject to the market. He doesn't know that.
Right, and the only assumption I'm making here is a 3% growth over that time. Okay.
Yeah, real estate appreciation, which is conservative.
3%.
Yeah.
At 3%. Again, historically, before the craze, our parents' generation and the generation before, which is more the reality of the world even we live in today, they were averaging 6-8%. We all know the story of the lady that bought her house for 50 grand and sold it for 1 million. And that happens a lot more than we think. And this is, just, I think I'm being conservative in saying 3%. Honestly, if I turn that number to 5%, it's going to be even that much more money. So again, obviously, me, I've said it and I'll say it again, residential real estate is back. I think the foundation is where it needs to be, like it was prior to the subprime days. And so we can count on the fact that we are going to have that appreciation historically, because your investment portfolio person is going to probably make an assumption of 8-10%, because that's what the S&P has returned. So there'd be a lot more equity and you'd pay it off a lot sooner. But this is, I think, very real. And just in the interest savings alone, if we took out appreciation, you're talking about 80 grand. So I'm still giving you 100% back on your money just based on interest.
Right. So the moral of the story is instead of going and finding a place to make returns, you can kind of look at your existing debt, save yourself from paying maybe hundreds of thousands of dollars to a mortgage company, keep it in your own pocket. And of course, it's an asset you control. It's your house. You can improve it, do whatever you want. You're in the driver's seat.
Absolutely. And like I said, you definitely want to fund your things like your retirement. And again, if you think about it from a long-term perspective, where you are going to retire in the next 20 years or 15 years, you are funding your retirement because you are just reducing the term of your mortgage, therefore freeing up more equity, paying off your mortgage faster. If you want to retire to Florida and living here in New Jersey, now you can sell your house and cash in, and you're going to realize that gain. You're going to realize that gain when you sell and you go buy your retirement home in cash, instead of worrying about, hey, I still have I got to pay off this $110,000 mortgage still. You just invest in it, because that 110 grand loan balance is interest.
Yeah. Cool. All right. So if somebody's out there and you're thinking about refinancing, even if you think you have a pretty low rate right now at 4.25%, you might find you reduce your term a bit. You might even want to explore kicking a little extra money in every month, bring your rate down, and it can have powerful effects long-term on your overall net worth.
I think if, what I would say, just to summarize what you're saying is, yes, if you're in a 30-year mortgage and you have that mortgage for a couple of years and you're in a situation where you're thinking about long-term financial goals, you should definitely talk to us in regards to reducing the term, even if it means increasing the payment a bit, and being able to invest in yourself to free up equity, and basically investing in yourself and paying yourself back the return instead of giving the payment to the bank. And by the way, Ryan, one last point on this is that we can do this any term you want. So if you have 27 years left on your mortgage and you would like to reduce the term to 25, that's fine. But if you wanted to reduce it to 22 years, we'll do a 22-year mortgage for you. If you have 20 years left on your mortgage and you say, I'd like to do a 10-year fix, but the payment's a little too high, and maybe the 15, I can afford a little bit more than a 15-year mortgage, we can do a 12-year mortgage for you.
Cool. So very flexible. There's plenty of opportunity right now. Rates are never going to be this low again unless they go lower next week, right?
Exactly. But they have been up and down. Just for the interest rate summary, yes, they have been up and down. We're on the higher side of where we were a couple weeks ago, for sure. All of the noise with North Korea and obviously, the hurricanes affected the markets a bit too. Those things have kind of gone, or yesterday's news cycle, as far as markets are concerned, it's still very real in all our minds and hearts, but the market has absorbed that. Interest rates have come back to more normal levels for the year. But again, historically, we're still in a pretty good spot that if you're looking to reduce the term, hey, if a 15-year, you're in the low threes. You can see 20-year rates and 25-year rates, you're in the mid threes. So I don't know where you're going to borrow money at 3% or how much longer we're going to be at those numbers that you'll be able to do that. And at some point, it's going to make sense for you to just stay in the mortgage that you're in. But this is a really good way to achieve financial goals and make yourself do it. Because again, you can throw a little extra principal at the mortgage and say, all right, if I make an extra payment, I knock off 5 years anyway. And if you're that disciplined, God bless you and keep doing what you're doing. But if you need a little discipline in your life to make sure that money's coming out of the checking account and you're following this plan, it's a couple $1,000s in closing costs, and those numbers are factored into there, and we'll put you on this. It puts you into a lower term mortgage, and you'll achieve your financial goals faster.
Great. Okay. Thanks, James. I'll make sure I put your cell number if anybody wants to call you direct near this, or they can email loaninfo@bondstreetloans.com.
All right. Great. Thanks, Ryan. Talk to you soon.
Yep.